Hey everyone, I am Divya Grover, here to help you take informed mutual fund investment decisions. The Indian equity market continues to face pressure from multiple factors. The ongoing effects of the US-Iran war and the resulting rise in inflation have weighed on investor sentiments. On top of that, expectations of a weak monsoon have further dampened market optimism. However, for long-term investors, market corrections often create opportunities. If you're looking to gradually increase your equity exposure for long-term wealth creation, value investing can be an effective approach. Value-oriented funds are designed to capitalize on short-term market pessimism by investing in fundamentally strong businesses that are available at attractive valuations. This gives them the potential to generate superior risk-adjusted returns over a complete market cycle. Now, as many of you may already know, value investing is a time-tested investment philosophy. It involves identifying fundamentally strong stocks that are trading below their intrinsic value. When market sentiment improves, these stocks can rebound and move closer to their fair valuations. Value funds focus on identifying exactly this kind of opportunities. Stocks that are temporarily out of favor with the market but have strong business fundamentals and the potential for recovery. In this video, we will look at the top 3 value funds based on risk-adjusted returns. These schemes have been shortlisted using a combined quantitative score that considers 6-month, 1-year, 3-year and 5-year rolling returns, along with risk-reward measures such as standard deviation, Sharpe ratio, Sortino ratio and up-down capture ratio. Let's begin with our first fund, ICICI Pru Value Fund. Launched in August 2004, ICICI Pru Value Fund, earlier known as ICICI Pru Value Discovery Fund, has consistently delivered strong long-term performance. This track record has helped it become the largest fund in the value fund category. One of the key reasons behind its success is its investment strategy. The fund avoids momentum-driven investing and instead focuses on large-cap stocks, which helps reduce risk while enabling it to outperform both the benchmark and majority of its peers. The fund also benefits from the expertise of veteran fund manager Mr. Shankaran Naren, who is widely known for his contrarian investing style and ability to identify value opportunities. Over the last 5 years, ICICI Pru Value Fund generated returns at a CAGR of 24.2% on a rolling returns basis. In comparison, the Nifty 500 TRI index generated 18.1%. The fund has also maintained one of the lowest volatility levels in the category. Its Sharpe and Sortino ratios rank among the best in the category and are significantly ahead of the benchmark. When it comes to portfolio construction, ICICI Pru Value Fund generally maintains a diversified portfolio of around 60 to 70 stocks. As of April 2026, the fund held 63 stocks. Its largest holding is in HDFC Bank, followed by ICICI Bank, Infosys, ITC and Reliance Industries. The fund typically invests with a long-term perspective and has maintained a moderate turnover ratio of around 45 to 50% in recent months. Sector-wise, its largest allocations are to banking, information technology and healthcare. Over the last 1 year, the fund maintained an allocation of around 77 to 85% in large-cap stocks, along with 10 to 13% to mid and small cap stocks. Now let's move to the second fund on the list, HSBC Value Fund. HSBC Value Fund was launched in January 2010 and was earlier known as L&T Value Fund. This fund aims to identify quality businesses by combining both value and growth investing while following a bottom-up stock selection process to generate alpha. Another strength of the fund is management continuity. The scheme has been managed by Mr. Venugopal Mangat since 2014, providing consistency in investment philosophy and execution. Over the years, HSBC Value Fund has built a strong track record of delivering robust returns across various time periods and rewarding investors with meaningful long-term gains. Over the last 5 years, the fund generated returns at a CAGR of 24.7% on a rolling return basis. Again, this compares favorably with the Nifty 500 TRI index return of 18.1%. While the fund's volatility is higher than both the benchmark and the category average, it has stood out in terms of risk-adjusted returns. In other words, investors have been compensated well for the additional risk taken. The portfolio is highly diversified with exposure to around 75 to 80 stocks across multiple sectors. As of April 2026, the fund held 81 stocks, keeping exposure to individual stocks below 5%. Its top holdings currently include SBI, HDFC Bank, NTPC, Reliance Industries, and Karur Vysya Bank. The fund also follows a long-term investment approach and maintains a moderate turnover ratio of around 30%. Sector-wise, around one-third of the portfolio is invested in banking and financial services. Other major sectors include crude oil, metals, information technology, and FMCG. Over the last 1 year, the combined allocation to mid and small cap stocks remained in the range of 50 to 55% of its assets. At the same time, the fund maintained a large cap allocation of around 42 to 46%. Let's now look at the third and the final fund on our list, HDFC Value Fund. HDFC Value Fund was launched in February 1994 and was earlier known as HDFC Capital Builder Fund. The fund follows a multi-cap strategy with a value-oriented investment approach. Its mandate requires at least 60% of the portfolio to be invested in companies trading at valuation multiples below the median PE or median PB of the Nifty 500 index, or below their own 5-year historical average trailing PE or PB. This disciplined value framework has helped the fund outperform the benchmark on multiple occasions and generate strong long-term returns. Over the last 5 years, HDFC Value Fund generated returns at a CAGR of 21.2% on a rolling return basis. The Nifty 500 TRI index by comparison generated 18.1%. The fund has maintained volatility broadly in line with the category average. At the same time, it has outperformed both the benchmark and the category average in terms of risk-adjusted returns. As of April 2026, the fund held 71 stocks. Its largest holdings currently include ICICI Bank, HDFC Bank, Axis Bank, SBI, and Bharti Airtel. The fund's key sector exposures are banking, auto and auto ancillaries, and information technology. One notable feature of the fund is its low turnover ratio of around 20 to 30%. This reflects the strong long-term conviction that the fund manager has in the portfolio companies. In terms of market cap allocation, the fund currently invests 62.5% in large cap stocks, 16.2% in mid cap stocks, and 17.1% in small cap stocks. So what can investors take away from all this? Value funds provide an opportunity to participate in the growth potential of financially strong but undervalued businesses. Because these funds invest in stocks that are available at attractive valuations, they may offer a better margin of safety compared to growth-oriented funds. However, it is important to understand that undervalued stocks often remain out of favor for extended periods. As a result, fund managers' investment decisions may take time to deliver results. This means value funds can underperform in the short to medium term, especially during momentum-driven market rallies. But over longer investment horizons, value funds have the potential to generate returns comparable to growth-oriented funds and in some cases even outperform them. And that's all for this video. If you found this analysis useful, don't forget to like, share and subscribe for more insights on mutual funds and investing. Thank you for watching and we'll see you in the next video. Mutual fund investments are subject to market risk. Read all scheme related documents carefully. Registration granted by SEBI, enlistment as RA and IA with exchange and certification from NISM in no way guarantee performance of the intermediary or provide any assurance of returns to investors. Investment in securities market are subject to market risk. Read all the related documents carefully before investing.